It is Wednesday, May 4th. This is Elliott Wave Cafe. I am your host, The Cowboy, and welcome to another edition of the Chart of the Day. Let's get started. All right, guys, how is everybody doing? Today we're going to take a look at the SP 500. It was a pretty eventful day, and we've had not only some important economic data that hit the tape, but we also had Jay Powell's press conference and the announcement on rates and the monetary policy, which happened today around 1 o'clock my time, and then the press conference was about 1:30. So the markets ended up the day with a pretty large rally, and I think we went up to close to 3%, if not more, in the equities overall. And the rally was across the landscape. So we not only had the stocks, equities, indices, all these, but we also had a bearish dollar, a move up in Bitcoin and crypto. We had the move up in bonds. So across the spectrum, there was quite a relief rally, quite a reversal from the bearish sentiment that's been kind of marinating in the markets, let's say, for the past several weeks, ever since we've been rejected from the top of this wave back in there. So, what's going on and why this happened, I think, is the first question. And then where is it likely that we can go from here? And, the market was, to my presentation here on YouTube and even in my channel, the idea was that the market was very bearish going into this event. The Federal Reserve was expected to raise rates with 50 basis points at this meeting, but it was projected to raise rates with 75 basis points going out into June. And that's an important distinction. I mean, the market takes these rate increases very seriously, and every single basis point that gets taken away from the market, if I can say that, it can lead to large price movements in equities. So here is what happened today. Jay Powell was asked about the likelihood of him raising rates with 75 basis points at the next meeting, which is in June, which is what the market has priced in through this kind of bearish decline. And Jay Powell was, quite a little bit, let's say, reserved into accepting, that statement. And, he gave a hint to the market that they're going to go out and raise only 50 basis points at the next couple of meetings and not 75 basis points. Now, the moment that statement came out, I think this question was asked by Steve Leisman from CNBC. The moment that happened, the markets took that as a sign of a relief and started to rally across the board. So, the idea was that the markets were so bearish moving into this event that Jay Powell would have had to be extremely, extremely hawkish to continue to destroy this market and push it further to the downside. So almost like the market would have had to, or the Fed would have to raise rates with 75 basis points and not 50, right? That would have been an extremely hawkish stance. Or if Jay Powell would have come out and said, yep, I think we're going to do 75 next. And not only that, but we're going to do 75, even at the next meeting. So not the one in June, but the one, I think it's in July or in August, whatever. So, this was the market's expectation, and this was the worst case scenario. And there was a big build up into it with a very, very large bearish sentiment. And as the markets relaxed from his statement, a lot of positions started to cover. These market participants that have been a long time in the market and they understand how the Fed works. They started to reverse course, either take profits or take the other side and open long positions. And it was just enough to kind of get up there for a kind of a phase ripple rally, from about 1:30, 1:45 till the end of the day. It's about 3 o'clock my time. So this was basically, this is kind of basically what happened in the markets today. Now, do we get excited about this move or we don't? Do you have enough information here to tell you that this market is reversing and moving to the upside? I think it's very, very premature. Now, the pattern in here looks pretty good. Looks like a reversal pattern where you sell off, you have this kind of bullish hammer at the lows, and then, you're engulfing the previous decline and you create a bullish close. So this is, for all intents and purposes, it could be considered a bearish reversal, but I think this is what it can happen further. So you can come back down in here maybe for a couple of days, right? And then just kind of retest the low side a little bit. And then you can go back higher once again. Then you can come back a little bit more. And then you can kind of continue to rally a little bit, right? Until you're maybe eventually getting up to these highs. That's the first level in the market that we're going to watch for targets in case this continues to push to the upside. Now, I have taken a long position in here a couple of days ago in anticipation of such an event. I was lucky enough that, Jay Powell wasn't hawkish, to kind of take out our positions and move to the downside. But you could kind of feel that the market was ultra heavy, and the asymmetric risk was to the upside. That's where you're going to have more reward than to the downside. So that's kind of what happened. So now, again, what's going to happen next? Well, we have to think about this, right? Bullard, and there are some other, Fed heads that might have, they might speak, if not this week, maybe next week, who knows? But, these guys can come back out and say, and provide all kind of hawkish statements still. So that's one risk to the market, right? That they can come down and say, well, yes, we're going to be data dependent, but, we're still going to tie it aggressively. And, if the data tells us that, the inflation, it's increasing, then we're going to jump over to 75% again. And then all of a sudden, this rally will get sold into however high it's going to be able to go. And then it's going to make a new low once again. So, and the first piece of data that we're going to get on that, there's a couple of them. The first one is going to be on Friday, where we're going to get the NFP report. So that's a non-farm payrolls, how many jobs have been created for the month of April. And then the next one that's important, I think it's next week, is the CPI number, where we're going to find out, I'm not sure if it's next week or the following week. I think it's next week. Where we're going to find out, what the inflation rate is, or year over year and quarter over quarter. But I think last time we were at about 8.5%. And, if we can come back down from those levels, then this move will be somewhat justified. And not only that, but the markets can continue to push higher and maybe overtake these levels, right? If the inflation data comes a little bit stronger than expected, right, that will give the Fed enough of a reason to come on TV or to just send a statement or whatever, or they don't even have to do that, but the market will just assume that that's what Fed Powell is thinking, that, well, inflation is pushing higher. On the next meeting, we're going to increase 75 basis points because that's what he said. He's going to watch the data. So everybody seems to believe and be in the camp, not everybody, but a large portion of the market, at least from my understanding, that the inflation has kind of topped off. It's going to stabilize for a little bit and then push back down. The factors around this don't matter at the moment. I'm not here to argue, pro or contra, but we're just going to kind of have to see and watch what happens. But the markets are very sensitive to that. And especially lately, since we've been having such a high inflation, we can get still a lot of jitter and a lot of volatility in these markets. So, the next piece of information is going to be important. I think it's obviously kind of what's kind of happening with the VIX. Now, the VIX today, I'm not going to show it here. I already talked about it yesterday and the day before, but the VIX has relaxed quite a bit, and that was a pretty good signal. So from a 33 to 34 VIX in the market, you're coming back to, let's say, a 24 or 28. I'm not sure what it closed off today at, but that means that the risk from this event has been taken out. And I think I've talked about this in yesterday's video, because, the VIX, people were buying puts like crazy and just, be fearful of this event. And the moment this event passed off and the market kind of had a sigh of relief, then, that VIX came down and it kind of helped, the risk, to rally. So we're going to watch VIX, kind of what's going on in there, and if it's going to stabilize, if it's going to come back to some lower levels, maybe near 20, 22, 23, maybe that's going to be a time where you can maybe sell a little bit of this market. But we're still, I think, fairly early. So what we're thinking in here is combining a little bit, the Elliott wave structure with the fundamental data, with the economic data, and see kind of how one can participate in these moves. The other point I want to touch on is the dollar, because the dollar basically, had a pretty strong rally for the past few weeks, and I've showed on Twitter and even in this channel that we are coming into heavy resistance levels into the dollar index, and the likelihood that that's going to pause, it's very, very high. And not only that, but it's probably going to correct quite a bit. So somehow these events are all correlated, and you can see that all it needed for the dollar was a little bit of a less hawkish Fed for it to sell lower. Is it the end of the rally? I'm not sure. We might get another wave higher, but I expect these levels, current levels, to be, to kind of hold, and for the dollar, if not, to kind of sell off, but at least to correct in a maybe more regular fashion, maybe a 23%, maybe a 38% of the latest rise in there. So, we've opened some long in the euro dollar. We have been, kind of rewarded on that as well. We have opened some long bond position into the 10-year, into the 2-year as well. So that kind of helped with today's rally as well, because as, volatility came down, as Powell was less hawkish, the rates started to pull back. So on the 10-year, instead of a 3%, now you're back towards 2.9 something, whatever it is at the moment. But it's been a relaxation into the yield. It's all kind of what's going on in those yields, because the market has already hiked for the Fed, right? You're up at 3%, let's say, in the 10-year. But in the meantime, if those rate expectations are coming down, then the markets will get a little bit of a repricing. I said this on Twitter too. The market will have to reprice itself and come back maybe toward more normal levels on the on the rates on the 10-year, on the 2-year, and so forth. So maybe it will come back towards 2.5. So I think there's still some juice left to the upside in the bonds as well. The other positioning we've done was some kind of a, short put strategies, where you're basically selling volatility and you're trying to take advantage in some of these stocks like ARK ETF, like, Snowflake, like SoFi, things like that, stocks that have an extremely high beta, right? That kind of, when the market moves, let's say 2-3%, those things can move 7, 8, 9%, right? Because they generate a lot more interest, and they're way more volatile. So selling puts in those, or even buying stocks outright, can generate quite a bit of income when the market kind of starts to work in your favor. So we're talking about the strategies in the program all the time, and this is one of the things that we've done, especially on the trading side. Now, kind of going back to the count. Long story short, I'm sorry for this, kind of ranting here about the markets, but I think it's important. So now we're looking at this. Hey, is this a W in here? Again, in an ABC sell-off with an ABC and an X wave. This was an A wave decline. We talked about this being a 1, 2, 3, 4, and 5. Maybe we're going to get an ABC rally back, maybe somewhere towards those highs. And then, maybe the next leg lower will begin. Being inflation data, being something else that spooks the market, and you're going to do a wave C of Y. So if this is A, you're going to get a B, and then down in C of Y. If this market continues to climb higher, right, and overtakes these levels and starts to retrace a bit more, and this is one of the clues that I'm kind of watching, is the retracement levels. If we're starting to get, let's say, above 61%, 61.8% retracement, or 78.6% for that matter, there is a likelihood that this correction here might be complete, and you can move to new all-time highs in the equities. Now, that's hard to believe at the moment, but this is kind of how things kind of start. You have a reversal, and then the bears get tested, right? Because a lot of people still might think that this is a bear rally, and what's going here, the market might test their endurance and say, or their resilience, and then say, well, let me see what you're thinking about that when you're getting into the 618. And then they're going to push it to 78.6, and then bears are going to start to doubt themselves and say, I don't know if it's a bear market rally. It might be, something else. What if I'm wrong? And the moment they pass about 618, 78.6, they start to close positions, and then it fuels a rally above the X wave, and then that's how the next rally begins. So, how you're going to count it in that way? Well, you might have to change it up to a flat, where maybe the interpretation here was wrong. This was, let's say, instead of a W, you have a wave A in there. So you would be something like this. And I've talked about this, I think a couple of days ago too. So you can go down in A, up in B in here. Or maybe I search it in the NASDAQ, but I looked in the NASDAQ, and then this could be a C wave decline, right? So instead of this being a WXY, we just kind of get this out of the way so you can kind of see it, right? This becomes just a simple ABC. This wave 4 moves back in here, right? And then you have a correction that mimics the second wave in here, and then you can move to new all-time highs. So this is one of the ways how the market can kind of punish and just say, no, you're not looking for a zigzag in here. You have just a simple, ABC in here, and, you can push higher. It could still be a larger triangle, whatever, but it is, it is one of the ways that, you kind of have to stay open and think, not to be stubborn in thinking, hey, only my wave count is correct and only this one is going to pan out, and you're frustrated if it does, and so on and so forth. So these are just things that we learn as Elliott wave participants and users, right? That these things are important to follow and to kind of watch. So guys, this is did I just change my chart? Yep. I had one that was kind of saved up, and I, my Motivate software just kind of switched to the other one. So anyway, my fault here I have a couple of windows open, but, I hope this was an informative, session in here. Please don't forget to subscribe and come and visit us into the program for daily videos like this and more information, trades and updates and all kind of things. And yeah, I appreciate you being here like always, and I will see you tomorrow. Bye-bye.